name is Ilya Sapranidi. I'm the head of research at Venture Lab, one of the teams behind neutrino and gravity protocols. First and foremost, I want to extend my thanks to Boğaziçi University for organizing this conference. So today I'm going to be talking about how DeFi, or decentralized finance, creates a novel and revolutionary independent financial system. We will go over the most prominent DeFi projects together and discuss trends and tendencies of the industry. So let me first start by saying that the blockchain industry has been experiencing a new upswing this year. Decentralized finance, or DeFi, also called open finance, is driving this trend. DeFi is an independent financial ecosystem without protectionism, corruption, or unnecessary intermediaries. It is built on the basis of decentralized applications that replace the usual financial institutions. The incentive for the market growth is free competition. So the best products which have proven their reliability and managed to attract the largest number of users achieve success. The DeFi industry is showing staggering growth rates in 2020. According to DeFiPulse.com, for example, at the beginning of September, more than $9 billion of crypto assets were circulating in it, while in January, this figure barely reached $1 billion. And at the end of 2018, only $275 million. So the secret of DeFi's success lies on the surface. Everyone, regardless of citizenship or place of residence, can participate in and use DeFi projects. Service protocols and economic models are fully open to inspection and audit, which provides additional security. You don't need to be a millionaire and open a brokerage account to invest in DeFi. Most platforms have virtually no bottom line. You can start with a few dollars by installing all the necessary applications on your computer or even on your smartphone. At the same time, investors never lose direct control of their assets and can get them back at any time. Now, let's talk about the economic and technical underpinnings of DeFi. Currently, the Ethereum blockchain is the most popular with developers, but DeFi services are also available on many other blockchains, such as EOS, Waves, Tron, Neo, Polkadot, or Binance Smart Chain. There's also a trend towards interoperability between blockchains, represented by, for instance, Gravity Protocol. In terms of technology, DeFi is based on a simple mechanism. A user sends some crypto asset that they own, for example, ETH or USDT, to the specific address of the DeFi platform smart contract. In return, they receive internal platform tokens. For example, on Compound, that will be CETH and CUSDT. These tokens can be used for trading or generating passive income. The user can always take back the original asset by making transactions in reverse order. If they receive the income, then when selling platform tokens, they will receive a larger amount of the original asset on their wallet. So tokens can be freely moved between different DeFi platforms using regular blockchain transactions. A user can get tokens from one platform and invest them into another, while retaining full control over their finances, which is hardly available in banks or on exchanges. But this independence has a downside, though. Only the owner of the tokens is responsible for their security and safety. If the keys to the wallet are lost or hackers steal them, the assets will be lost irretrievably. Therefore, DeFi users need to really grasp how smart contracts work, as well as the basics of information and operational security. Now, let's move on to discussing popular DeFi dApps that exist. In general, DeFi infrastructure consists of several types of platforms or applications. Let me describe them now. The first type would be stablecoins. So unlike classical stablecoins, which are tightly tied to an underlying asset, it's usually the US dollar, DeFi proposes algorithmic stablecoins. The first to emerge were algorithmic stablecoins based on the collateralized debt position, or CDP. The token price with CDP is synchronized with the underlying asset using a smart contract that issues or liquidates special stabilizing tokens. So, for instance, this is how the DAI of the MakerDAO project works on Ethereum, or the USDJ platform Just on the Tron blockchain. On the other hand, the neutrino USDN stablecoin, which is issued on the Waves blockchain and backed by reserves in the Waves coin, has a newer and more original model. Its price is stabilized against the US dollar using the so-called NSBT token, or neutrino system-based token. The main feature of USDN or USD Neutrino is the possibility of staking. That is the issue of tokens through the LPOS or least proof of stake mechanism. If a user blocks their USDN in a smart contract, they will receive a daily profit in tokens through staking. Now, let's move on to decentralized lending platforms. Such platforms are designed for P2P lending in crypto assets. The borrower pays and the lender receives a percentage determined by the balance of supply and demand for a specific asset. You can borrow, for instance, USDT, DAI, USDC stablecoins, as well as Ether or WBTC and popular ERC20 tokens. In terms of blocked assets, the leading platforms at this moment are Maker, $1.5 billion, Aave, $1.45 billion, and Compound, $676 million. Now, another crucial component of the DeFi infrastructure is decentralized exchanges or DEXs. DEXs trade in DeFi tokens and other projects present on the underlying blockchain. Each transaction is recorded as a transaction on the blockchain. And so this reduces the speed and liquidity of transactions, but users still can retain control over their assets. On a DEX, an account is usually not even required. It is replaced by an address of the cryptocurrency wallet. The largest decentralized exchanges on Ethereum are Uniswap and Curve Finance. The Waves blockchain operates the Waves exchange of the same name, which combines the functions of traditional and decentralized trading. Now let's talk about tokenization of assets, which is another important trend. So another direction of the DeFi industry is the tokenization of real-world assets, such as metals, stocks, currencies, and also the creation of synthetic products based on them. Tokenization platforms lower the entry barrier for low net worth users and allow traditional and crypto assets to be traded in one place. They can compete with the traditional derivatives markets that is represented by futures and options. Holders of cryptocurrencies do not need to exchange them for fiat money to start trading. Tokenization platforms are now in their early stages of development. For example, these are the Synthetics Derivatives Exchange and the Yearn Finance product. So the evaluation of a DeFi project to choose depends on two weakly correlated components. One is the capitalization of its own token and the total market value of the assets placed in it. Proprietary governance tokens of projects are usually represented as tokens of the ERC20 standard or its equivalent. Their number can be constant, such as the case with Lend and Yearn Finance, or it can change according to an established algorithm, such as in Compound, Maker, or Balancer. If there are changes in the project's smart contracts, they should receive the votes of the majority of holders of these governance tokens. So the governance token does not directly affect the day-to-day operations of the platform. It does not generate passive income. Its price is formed mainly speculatively on centralized exchanges and is highly volatile. Operational tokens, on the other hand, they duplicate crypto assets locked at smart contract addresses. They are created when deposits are made on the platform and are redeemed if the user withdraws the underlying crypto asset. For example, on Compound, these are C tokens like CBTC, CETH, CUSDC, etc. These tokens do not participate in smart contract management, but are a source of income. Their value is equivalent to the value of the original asset, and their total value determines the real investment in the platform. Now, let me explain to you how to invest and participate in DeFi. So there are several major models for generating income from investing in DeFi. The first is receiving interest on deposit, which is the easiest way to get passive income. To do this, it is sufficient just to put your crypto assets on a platform like Compound. The percentage is dynamically calculated based on the ratio of the volume of loans to the volume of supply. Another method of investment is yield farming, which is an active method. That is, it requires a constant search for the most profitable way to place tokens. Well, it takes time and knowledge of the market from the investor to understand which yield farming method to choose, but it can significantly increase your income. One of the types of farming is liquidity mining, that is, placing tokens in so-called liquidity pools and receiving additional rewards in native tokens. This is represented by comp on compound or BAL on balancer. Another way to receive income through DeFi is purchase of management tokens for DeFi projects. Tokens of promising projects have already shown thousands % of growth in a few months. They usually have no intrinsic value, do not require collateral to be issued. Therefore, they are subject to high volatility, which means that trading them can bring speculative income, but long-term investment carries high risks. And the final method is staking. That is the generation of a crypto asset using the POS or proof of stake consensus method. In the DeFi industry, it is available for some ERC20 tokens, such as Synthetics, as well as BNB or on Binance Smart Chain, and USDN or USD Neutrino on Waves. There are staking pools that provide a single interface for staking different assets. Staking profitability varies depending on the current share of tokens involved in the process. Now, to sum it up, let's talk about DeFi regulation and its perspectives. There's no specific regulation for the DeFi sphere yet in any country, since even the status of cryptocurrencies is still very little defined. In countries where there is regulation and taxation of crypto assets, for instance, Japan, Australia, the USA, some EU countries, etc., the proceeds from DeFi will obviously be considered under their current legislation. And it is still early to say that the industry is transparent and fully regulated. Now, even without considering the regulatory ambiguities, the future of the DeFi industry is not predetermined. Cryptocurrencies gave people the opportunity to manage their money without the control of governments and intermediaries. And ICOs opened up an alternative source of funding for projects. For the first time, DeFi offers a complete independent financial ecosystem that includes all the platforms and services one might need. However, the DeFi industry will have to face serious competition from the traditional financial sector, fintech companies, open banking applications, and central bank digital currencies, CBDCs. And after the initial hype subsides, it will still have a long way to go to expand and standardize. So thanks a lot for your attention. You can reach me on Telegram and follow the official Waves channels for news and updates about the Waves ecosystem. Thank you.